Most real estate mistakes happen before the property is even purchased. Investors lose money not because real estate fails, but because analysis is rushed, emotional, or incomplete. A strong deal is built on numbers, structure, and clarity, not excitement. In this video, you will learn how to analyze a real estate deal step by step using a simple system that experienced investors rely on to reduce risk and protect returns. Like and subscribe to continue learning practical methods that build long-term financial confidence. 1. Understanding the purpose of the deal. Every real estate deal must begin with a clear purpose. Investors decide whether the property is meant for rental income, appreciation, or long-term holding. Purpose determines how numbers are evaluated and which risks matter most. A deal that looks weak for short-term profit may be strong for long-term income. Without clarity, investors misjudge opportunities. Purpose creates direction and filters distractions. Defining intent prevents emotional decisions and aligns analysis with strategy. Strong investors never analyze blindly. They analyze with intention. 2. Evaluating the location. Location influences demand, income, and long-term value. Investors analyze employment access, schools, transportation, and population trends. Strong locations support consistent rent and lower vacancy risk. A poor location increases management challenges regardless of price. Analysis includes neighborhood stability, future development, and supply levels. Location cannot be changed after purchase. Investors treat location as a primary risk control factor. Good numbers in a weak location often fail over time. Strong locations protect downside and support growth. 3. Understanding the purchase price. Purchase price sets the foundation for returns. Investors compare price against comparable properties' income, potential, and replacement cost. Overpaying limits flexibility and increases risk. A fair price allows margin for error. Analysis includes negotiation potential, seller motivation, and market conditions. Price discipline protects capital. Investors avoid emotional bidding and focus on value. A good deal is created at purchase, not after. Strong analysis ensures price aligns with long-term objectives. 4. Estimating rental income. Income estimation must be realistic and conservative. Investors research current market rents rather than assuming future increases. Vacancy assumptions are included to reflect real conditions. Income analysis focuses on achievable rent, not ideal rent. Overestimating income is a common mistake. Reliable numbers protect cash flow projections. Investors use local data and comparable rentals. Accurate income estimation anchors the entire deal analysis and prevents false optimism. 5. Calculating operating expenses. Expenses determine true profitability. Investors list all recurring costs, including maintenance, taxes, insurance, management, and reserves. Ignoring small expenses leads to inflated projections. Conservative expense estimates protect against surprises. Investors plan for repairs before they occur. Expense discipline separates professionals from amateurs. Analysis focuses on net income rather than gross rent. Strong expense control reveals whether a deal truly works. 6. Analyzing cash flow. Cash flow is what remains after all expenses and financing. Positive cash flow provides stability and flexibility. Investors calculate monthly and annual cash flow under realistic assumptions. Break-even scenarios are evaluated for safety. Cash flow analysis reveals whether the property supports itself. Deals that rely on appreciation alone carry higher risk. Strong investors prioritize sustainable cash flow over speculative gains. 7. Financing structure review. Loan terms impact risk and income. Investors analyze interest rates, payment stability, and loan duration. Fixed payments provide predictability. Financing must align with income levels. Over-leveraging increases vulnerability. Conservative financing protects during vacancies and market changes. Analysis includes down payment impact and long-term affordability. Smart financing strengthens deals rather than pressuring them. 8. Measuring return metrics. Return metrics are used to evaluate the efficiency and effectiveness of invested capital. Investors analyze income in relation to actual cash invested, while also accounting for long-term equity growth and appreciation. Multiple scenarios are reviewed, including conservative projections, to understand how performance may vary over time. Returns must justify both the financial risk and the operational effort involved. Pursuing high returns without stability often increases exposure to loss and volatility. Balanced, realistic returns support sustainable growth and capital preservation. Clear metrics allow comparison across opportunities and eliminate ambiguity. 9. Stress testing the deal. Before committing capital, investors stress test each deal against unfavorable conditions. Scenarios such as reduced rental income, increased expenses, interest rate changes, or temporary vacancies are modeled to evaluate resilience. Stress testing reveals whether a property can withstand pressure without compromising cash flow or solvency. This process reduces surprises and replaces optimism with preparation. Investors ask what happens if conditions deteriorate, not just when they improve. 10. Final decision and discipline. The final step in the investment process is disciplined decision-making. Not every opportunity deserves acceptance, and walking away is often a strategic success. Investors rely on analysis rather than excitement, urgency, or fear of missing out. Clear criteria simplify decisions and create consistency across investments. Discipline protects capital, preserves focus, and aligns actions with long-term objectives. Real estate success begins with disciplined analysis, not luck or timing. When each step is followed carefully, deals become predictable and controlled. This process protects capital, reduces stress, and builds confidence over time. Investors who master analysis make fewer mistakes and stronger decisions. Like and subscribe to continue learning structured systems that turn real estate from speculation into a reliable long-term wealth strategy.